Hello everyone, we are Group 1 and today the topic we're going to present is financial analysis of the Top Globes Corporation Berhad. So before we start, I would like to introduce you our group member. So my name is Xu Zhechen. I'll be presenting the liquidity ratio and the background of our company. Then I will pass it to Liu Wenlei.
Hello everyone, my name is Liu Wenlei. I'm going to present the analysis of the leverage ratio and the conclusion.
And Ma Dingding.
Yeah, hello everyone, I'm Ma Dingding and my part is about profitability ratio.
Zhang Yiming.
Hello everyone, my name is Zhang Yiming, so I will present the third part, activity ratio in the video.
And Zhao Shuci.
Hello everyone, I will present the market ratio.
Now we move on to the introduction and the background.
Our presentation is divided into three parts. First is the background, then followed with financial analysis, and then last is conclusion and recommendations. Now we move on to the background part. The Top Globes Corporation Berhad is a Malaysia-based rubber glove manufacturer, which provides various kinds of other products, including face masks, condoms, dental dams, etc. Their facilities are all across South Asia, as well as US, Germany, and Brazil. The company was founded in 1991 by a rubber plantation owner with only one single product line and 100 staffs, and later became the world's largest glove manufacturer, which takes up 26% of the world market share. The Top Globes was listed on the Kuala Lumpur Stock Exchange in August 2001, and sooner in 2006 ranked number 9 on the main board of Singapore Exchange. In April 2018, Top Globes conducted its acquisition towards the leading surgical glove maker, Aspen SDN BHC, its biggest merger and acquisition so far, which was also a sign of Top Globes marching towards the world's largest surgical glove manufacturer. In the last year, the company was challenged by COVID-19. The labor and material shortage was causing decrease in production. Top Glove is currently in the third stage of the United States Customs and Border Protection, aka USCPB, Withhold Release Order (WRO) modification process to remediate the remaining 5 forced labor indicators that are pending verification by Impact. In 2021, the Top Globes maintained 30% of global market share as a target despite the setbacks due to dispute with the USCPB regarding to the forced labor issue. The chairman was really confident that the company would earn themselves a place in Fortune Global 500 company in 2030. That'll be all of the background part. Now we move on to the financial analysis of liquidity ratio. We begin with the time series perspective. The graph and table given on the right is ratio analysis of Top Globes from 2017-2019. From time series analysis perspective, our liquidity ratio signaled a declining trend, which implied that Top Globes were continuing weaker their position in fulfilling their short-term obligations toward their debts. Keeping less amount of cash and cash equivalent could put the company in an embarrassing situation where they might feel short-handed in payments. Now we move on to the cross-sectional analysis section. The table on the left are cross-sectional analysis of 3 target companies, the Top Globes, Hartelga, and the SuperMX. For 2017, the all stats of liquidity ratio from Top Globes are in the middle of Hartelga and SuperMX, where Hartelga kept the best statistical performance while SuperMX was in the bottom. In 2018, liquidity ratio of SuperMX was improving compared with 2017 stats, and even surpassed the Top Globes in the cash ratio, where Hartelga still remains supreme position. In 2019, the SuperMX exceeds Top Globes in all statistics, where Hartelga remains dominant position with statistical advantages. We can see from the table that most of the time, with SuperMax and Ortega keep sustained amount of cash, while Top Glob's cash amount was only half compared with the beginning figure. Furthermore, the Top Globes post less competitive advantage in their inventory in all time compared with the other two. So in the conclusion, the Top Globes is rather weak in liquidity ratios compared with other two companies. That'll be all of my part. Thank you.
Hello guys, I'm Ma Dingding and my part is to predict the probability ratio. Probability ratios are a class of financial metrics that are used to assess a business' ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time, using data from a specific point in time. So how to analyze these probability ratios? We need to calculate the gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. So I have found these 5 formulas, which is gross profit margin is equal to gross profit divided by revenue and multiply with 100. Operating profit margin is equal to operating income divided by total revenue and multiply with 100. Net profit margin is equal to net income divided by revenue and multiply with 100. Return on assets is equal to net income divided by assets and multiply with 100. Return on equity is equal to net income divided by shareholders' equity and multiply with 100. And the next part is about probability ratios analysis by time series perspective. So I have calculated the gross profit margin, operating profit margin, net profit margin, return on assets, and the return on equity of Top Globes in these 3 years. So based on these 2 tables to analyze the probability ratios for 2017 to 2018. The company's general functioning is showing the signs of improvement and the gross profit margin grows more faster. But the decrease of ROA demonstrates that the company's accumulated assets are inefficient. So the possible sales and potential profits are also reduced. In 2018, gross profit margin, net profit margin, and return on equity came to its highest point. The company's earnings were relatively high this year. So for 2018 to 2019, from the sheets we can get that all values have decreased. So the overall trend is decreasing, perhaps due to its inefficient competition, raising inventory costs, and so on. So the company's sales have not increased significantly. And last part is about Top Globes compared with Hatalika and Supermix. So I calculate the gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity in these 2 companies compared with Top Globes. So from the charts, we can clearly know that Hatalika company has higher profitability ratios. Since compared to other 2 companies, Hatalika has a higher ROA and ROE. So it means that the Hatalika's sales and potential profits will be higher and the net income will also increase. And for Supermix, this company's gross profit margin increased faster, but Supermix has lower ROA and ROE. Top Globe has lower gross profit margin, so it may spend higher costs than Hatalika and Supermix. Maybe the operation of Top Globe is not effective and efficient. That's all my part. Thank you guys. Let's move on to our next member.
Hi, I'm John. So activity ratio can be used to evaluate the efficiency of a company operating its assets. The activity ratio generally include inventory turnover ratio, total asset turnover ratio, average collection period, and average payment period. So this part, we will use this above ratio to measure the effectiveness of 3 companies' use of resources. So first, we will use the time series perspective to analyze the activity ratio of top gloves. So the inventory turnover is equal to cost of goods sold divided by inventory. And after calculation, the inventory turnover ratio from 2017 to 2019 are 8.9, 6.7, and 6.2 respectively. And next, the total asset turnover ratio, we find top gloves net sales divided by its total assets. So the total asset turnover ratio in these 3 years are 1.13, 0.79, and 1.27. So from a time series analysis perspective, the company has a high inventory turnover ratio between 5 and 10, which indicates that the sale and restock inventory every 1 to 2 months. This ratio strikes a good balance between having enough inventory on hand and not having to reorder too frequently. Although showing a slow downtrend, the company's sales spend is still very fast. There is still enough demand for products. The total asset turnover ratio of the company is about 1, which remains stable. It implies that the company is efficient in generating sales or revenues from its asset base. Next, we go to the average collection period and average payment period. So we use accounts receivable divided by net sales divided by 365 days. So we can get the average collection period. So the results are 44.8 days in 2017 and 75.9 days in 2018, 41.9 days in 2019. And then we use accounts payable divided by average purchase per day to calculate the average payment period. So the average payment period from 2017 to 2019 are 8.9, 6.7, and 6.2 respectively. We can see from the chart that in 2019, both average collection period and average payment period have a downward trend compared with previous years. There is a high average collection period, indicating that the company may have some problems. From the perspective of logistics, it may mean that the company needs to better communicate with customers about their doubts and payment expectations. And as for the average payment period, the company may need about 40 days to pay the accounts payable. And then we go to the second part. We choose Hatalaga and Supermix to do the cross-sectional analysis. And as before, we calculate the activity ratios of the 2 companies and compare them with top gloves. And then we go to the second part. We choose Hatalaga and Supermix to do the cross-sectional analysis. And as before, we calculate the activity ratios of the 2 companies and compare them with top gloves. Through cross-sectional analysis, we can know that the top gloves has higher inventory turnover, strong liquidity of inventory assets, and higher efficiency of capital use compared with the 2 other companies. In terms of total asset turnover, Hatalaga's 3 years total asset turnover is generally lower than that of the same industry. It's not good for the company as the total assets aren't able to produce enough revenue at the end of the year. The company should analyze how the assets are used and ways to improve the productivity of each asset. From the perspective of the average collection period, the collection management efficiency of the 3 companies needs to be improved. From the perspective of the year, the average collection period of top gloves in 2018 and Supermix in 2017 is high, which will have a certain adverse impact on the company's cash flow. In terms of average payment period, the 3 companies are at a good level. The collection efficiency of top gloves and Hatalaga is very high, and a lower average collection period indicates the organization collects payments faster.
Hello everyone, my name is Liu Wenlei, and this part is about the conclusion and recommendation. So in general, the main reason for the company's declining performance in 2019 is that the company turnover mainly comes from the ordinary gloves with low profits, and the freeze pricing pressure offsets the increase in demand for gloves, which affects the company's future profits. And the Top Glove note losses at its vinyl glove segment. Also, its natural glove segment delivered better performance with a strong sales volume growth about 30%. At the same time, the company carried out a small number of leave-offs, using more advanced equipment and technology to improve the level of mechanical automation equipment. The high level of debt of the company in 2019 is mainly reflected in the glove industry with the excess capacity. Management needs to control the flow of funds into vinyl glove segment and improve the mechanical automation and work efficiency to the equipment, and also increase the proportion of the investment in the natural glove segment with high returns when the sufficient funds are available. It will also release the funds occupied for a long time to improve the operation efficiency. The second is that the company needs a reasonable capital structure. If the proportion of the fixed asset is too high, and it will also affect the liquidity, and resulting in a shortage of the cash flow and affect the ability of the enterprise to repay the debts. Excess liquidity also will affect the efficiency of the use of the funds. Therefore, reasonable allocation of the capital structure is conducive to improving the return on assets. The third, as one of the largest glove manufacturers in the world, the company needs to explore the market to increase its market share as more and more pairs join in, so which will squeeze the company's operating scale and profits. For example, develop new gloves and recommend new gloves products to old customers, and seize the market of similar products and seize the first opportunity in the top-line gloves industry. So the high market share of the company in the gloves market will provide more opportunities for the company to make profits more from the different gloves. Or the leverage ratio equals the total liabilities equals total equity. And leverage ratio for 2017 is about 0.447, and for 2018 is about 1.208, and for 2019 is about 1.227. So the basic situation for cooperative leverage ratio. First of all, analyze the ratio of the 2017 to 2018. The leverage ratio is less than 1 in 2017 and maintaining a relatively normal level. So with a significant growth in 2018 and a small growth in 2019 and compared with 2018, but it's still at a high level. So for 2017 to 2018, in the cases of the excessive exceeding debit, and the price of the own profit is not enough to maintain the operation of the enterprise. Therefore, the demand for loans has increased, which is one of the reasons why the debt level of the enterprises has increased significantly. Also, the second is the deficiency of the financing structure. The emergence of the more financing structure reduced the effect of the policy of controlling leverage ratio, and making some enterprises with overcapacity continue to raise leverage ratio in the case of the high debt. For 2018 to 2019, the leverage ratio in 2019 is still at a high level. This indicates that the financial position of the company is not good, and there is a high-risk financing level in recent years. If the leverage ratio continues to be greater than 1, and the company will not be able to bear a higher debt level in the year after 2019. And also compare with the different companies in 2019, and the leverage ratio of the Top Glove for 2019 is about 1.227, and Hurtgula is about 2.324, and Supermax is about 2.625. And compared with the other two companies, the Top Glove has a highest leverage ratio and more than 1. And Hurtgula has the lowest leverage ratio. The leverage ratio of the company Hurtgula and the Supermax is maintained at a general level. And while the debt risk of the company Top Glove is also high, and it is likely to have problems in the solvency. Although there is a low debt ratio in this company, it does not mean that the company's financial situation is not good. It also means that the company has a riskier financing structure and also can bear a high debt level.
Hello doctor and hello everyone. My name is Zhang Shuci and I will explain to you the market ratio of the top global company. When the earnings per share value of stock or company is calculated using net income, non-cash expenses such as depreciation and amortization are abstracted from net income, and the lumpy nature of capital expenditure can cause a company's net income to vary greatly across reporting periods. Business can have much different non-operation expenses, such as tax and interest payments, which affect net income. A company's net income doesn't accurately reflect its cash flow or the health of its business, so we use price-to-earnings ratio to compare the company's stock price with its earnings per share. As we have using the formula, price-earnings ratio is equal to price per share divided by earnings per share. As we have data from the annual report, then we easily calculate the price-earnings ratio. Then we have found it so high. Companies with high price-earnings ratio are often considered to be growth stocks. This indicates a positive future performance. And investors have high expectations for future earning growth are willing to pay more for them. But the downside to this is that growth stocks are often higher in volatility, and this puts a lot of pressure on companies to do more to justify their high valuation. For this reason, investing in growth stocks will more likely to be seen a risk investment. Stocks with high PE ratio can be considered overvalued. Compared with the different ratio in 2017 to 2019, the company's performance first increased but decreased in 2019. The sudden increase of the price-earnings ratio in 2018 is due to the increase of the stock price. At this time, the reference value of the stock investment cannot be improved. With the improvement of the operation conditions and the increase of the performance from 2018 to 2019, the ratio will decline significantly in 2019. However, in terms of the growth manufacturing industry, the development perspective of the such company is better than the labor-based industry. With the transformation of economic development mode, the proportion of industry with strong growth and the significant development potential will be higher, which is the reason why the proportion of companies in 2018 are decreased significantly. The price-to-book ratio helps investors evaluate a company by providing a fairly stable indicator, which is intuitive and can be easily compared with a company's market price. The role of the price-to-book ratio is for investment analysis. The book value of stocks is reflected by the net assets of each share, which is measured by cost, and the market value of each share is the value of these assets now, and is also the result of transactions on the security market. The price-to-book ratio can better reflect whatever you pay, there's a return, and it helps investors discover whether listed companies can get higher output with less input. For investors, the relative high ratio indicates that the company has great potential for growth, but market investment risk will be higher. We need to compare the different ratio with other companies. We have compared with the ratio of 3 companies. The market ratio of Top Glove is lower. For the same glove manufacturer enterprise, Hatalaga and Supermax, Top Glove's main sources of profit is gloves with smaller revenue, while other companies focus on the manufacture of high-end gloves. Therefore, the probability and development potential of the smaller company are higher, which is also the reason for better operation of the 2 companies. In comparison with the size of the company, Top Gloves, as one of the largest glove manufacturers in the world, has a large score, which means that the total market value is large, and the higher funds are required to increase the price of the share. Otherwise, the ratio will be decreased. For Hatalaga and Supermax, the growth and development potential is high, and the small companies with small stock calculation will also lead to a higher ratio. That's all for my part.